Hey, this is Skyler with Regan. Just a quick update on the news that came out yesterday. I have up here on Truth, President Trump's post that they're going to be buying $200 billion in mortgage-backed securities. He has directed Fannie and Freddie. Secretary Holt came out, said he will be instrumental in purchasing this 200 billion. Well, what is also clear is that Fannie and Freddie have already been stockpiling mortgage-backed securities. At the beginning of the year, Fannie and Freddie combined owned about $165 billion in mortgage backs. This is their portfolio holdings. That has since increased to over 220, about $225 billion. So that's an increase of about 50 to $60 billion since the beginning of January of 2024. Now, what effect is this having on the market? Let's take a look. So, generally speaking, mortgage rates have been coming down precipitously. We're looking at one of the lowest mortgage rates we've seen since 2022 at about six and a quarter. If you're a high quality borrower right now, if you're putting down 20%, pretty good FICO score, you can get a five handle mortgage rate. Okay. Why is it coming down? Why are mortgage rates coming down? A couple of different factors, one of which is bond volatility. This is the MOVE index. MOVE index is also almost at its lows all the way back to 2021. If volatility is down, that means that folks are willing to buy mortgage-backed securities and accept a lower premium over U.S. Treasuries, okay, because there's less optionality, so to speak, in the movement of those levels. Second of which is the shape of the curve. So this is twos to tens. Over here, you have 2-year interest rates, which way back then, 5 years ago, was at 10 basis points. The 10-year got to as low as 1.02%. So the spread between those two basically defines profit for banks, real estate investors, any type of leverage investor that is borrowing short and lending long. When that went negative, usually that precedes a recession. A recession hasn't come yet. It's now positive. It's back to about 67 basis points positive, i.e., if you borrow twos and invest in tens, you're going to make 67 basis points. What I think is even more important is the 3 month to 7 year trade. Okay. 3 month is effectively where folks are actually borrowing. 7 year is effectively where they're investing. The duration on 7-year treasuries is roughly 6 years. That's exactly the duration of the U.S. ag. And you can see that's gone positive. It's as positive today as it was going all the way back to about mid 2022. Now, what effect is this having on mortgage spreads? This is really the punchline. Okay. Mortgage spreads were as high as 165 basis points. That's 1.64% over U.S. Treasuries back in April of last year. Just recently, they were at their lows, really going back a while, which was about 110 basis points. Let's expand that to 5 years out. That was at its low all the way back to about 4 years ago, March of 2022. But with this announcement from the administration that they're going to buy 200 billion, we've seen spreads drop to 91 basis points. That is really back to normal. Normal's 80 to 100 basis points. So we are back to normal. This is great for discount mortgage bonds. And all of this is despite U.S. Treasuries actually selling off. Okay. So if we look at U.S. Treasuries from the start of the year to today, they're actually higher in the 1 to 3 year part of the curve and across most of the curve. So you have a very, very flat curve. U.S. Treasuries bonds really haven't done anything yet this year, but we will see mortgage backs up 1 to 2% just on this move. And this drop in spread will lead to five handle mortgage rates within the next 10 days. Thank you.